Hi, my name is Liz Thompson, and this is a video for IME 315, Financial Decision Making for Engineers at Cal Poly San Luis Obispo. This video is on saving for retirement.
So when we're talking about the 5 topics in this class, this particular video has to do with personal financial decisions, but it also uses analysis techniques that you'll be using in investment analysis. So when we talk about retirement, most people think their income in retirement are going to come from 3 different areas. The pension from a particular company that you've worked for, Social Security, which is a federal program that gives you retirement income, and then personal retirement savings. So we're going to go through each of these. Pensions are developed by companies or the entity you work for. Like I work for the state of California, so it has a pension. These are company sponsored income after retirement. So you pay into the system, but also the company includes this as some of your benefits for working for them. It's based on years of service and age at retirement. So however long you've been working for a company plus your age. So that will then give you some particular level of pension. There's often also survivor benefits. So if you are married or have children and you die during your retirement, the income will also go to those survivors. Lots of times the way this works is there's a formula that's called 2%, and it's 2% times the years of service. So if you've worked for a company for 30 years and you multiply that by 2%, that's 60% of your salary at retirement. So continuing after your retirement, you can get 60% of your salary in this particular example. Or they sometimes give you a lump sum. So instead of giving you a particular percentage of your salary, they will do a calculation and give you a lump sum. Now that's all very good, and this used to be very common for companies to give pensions, but most companies now have switched to personal retirement encouragement through the IRS tax benefits, and we'll talk about that when we talk about personal retirement. But it's my assumption that when you work for a company, your pensions will be very small or non-existent. So I would say that you should not count on this. People who've been working for companies now, or your parents or your grandparents, they did count on pensions, but I think you should not count on a pension. So Social Security then is the next thing we'll talk about, and this is a federal program that when you in your paycheck you pay Social Security. I don't know if you remember that it's 6.25% of 6.2% of your salary goes to Social Security. And what's happening now in the Social Security is that the income you're paying is actually not necessarily getting invested for you, but it's being used to pay current retirees. So the theory is that you would put that money aside in investment, and then when you retire, you could get it. But the way the Social Security system right now is that what you pay in pays current retirement. So the thought is that this is not going to work in the long term, and I would say you shouldn't count on Social Security, even though that's something that you pay into. You shouldn't count on it. So if you remember, the employer and the employee pays 6.25% of this into income. So it's quite a bit. At 12.5% of your income is paid into Social Security. You then get a monthly income based on age and years working, or the amount you've paid into it. There's also survivor's benefits in this system, and that's really great. But again, I would say you shouldn't count on it because of the insolvency of the system or the unsustainability of the way it's developed right now. So what I'm going to argue to you is that you should really be thinking only in personal retirement savings, and how are you going to plan for that? So when we look at this, there's a couple ways that the government has encouraged retirement, and it's mostly through retirement savings, and it's mostly through the IRS tax code. And there's 2 general types, although there are a lot of variations in this, but when we talk about it, there's 2 types. IRAs, which is an individual retirement account, and 401k, which is a company-sponsored retirement account. And I'm going to go through both of those. And then also we're going to talk about how much money you might need to put into the system and to take out of the system. So when we talk about IRAs, or individual retirement accounts, this is often what happens is that you can put money into an IRA at pre-tax. So that means that you don't have to use your take-home pay. You can actually contribute before taxes are calculated. And this is actually quite good because you can lower your tax burden by having an IRA. And it's actually deferred though. So when you take it out of retirement, then you'll be taxed on it. In addition to, and there's limits associated with this, whether you have a 401k, and you definitely need to talk to an advisor about when you can do pre-tax contributions. But always interest income on the individual retirement account is deferred interest income. So when you take it out, that's when you pay tax on the interest you've earned. So that's a good thing, because if you have earnings all along, if you have a large retirement account, it could actually be quite a bit of interest income, and you can defer that. There's limits to contributions, approximately $6,000 a year, but that also varies, and it varies depending on whether you can have a pre-tax contribution. So definitely talk to a tax advisor if you're thinking about using an individual retirement account. And then, so this is what the cash flow looked like. You make deposits, and then at the end you take it out. The other option is a 401k, which refers to the particular place in the IRS tax code. That's why I called it a 401k. And again, there's variations on this, but this is the main one that you'll be looking at. And this is actually where a company helps you to put away money. And again, this is a pre-tax contribution, so it lowers your income tax. Deferred interest income, so if you're making interest income on this, you don't have to pay it until you take it out at retirement. But one of the best things about this is that it is possible to get company matching, and there's a vested period. So if you see the cash flow on the right, it's not only your contribution, but the company matches this contribution. So it is actually like 100% return the moment you make deposits. Now, again, there's limits, and not all companies match 100%. Sometimes they match 50%. But if the company you work for has a matching program, it's super duper important to use that as your retirement, because this will help you to save for retirement. So those are kind of the retirement savings things we're going to look at. And what I've done here is created a cash flow diagram that looks at how do we think about retirement savings. So from the years, say 25 to 65, you're going to be contributing to to a savings account. And I've had the double arrows because I'm hoping that your company will match those contributions. And then after retirement, you're going to start taking out monthly contributions. And this will occur infinitely because you don't know how long you're going to live. So you need to count on this income for quite a bit of time. So you want to really think about it as an infinite cash flow time period. So when we do this analysis, what I'm trying to figure out is how much do I have to deposit in the bank right now in order to get the income I need into the future. So I'm going to look at this kind of in two parts. First, I'm going to look at the idea that I want to have an infinite income forever. So I need to know how much do I need at retirement. And the second part is, now that I know how much I need at retirement, how much should I be contributing? So we'll go through this in a sort of a two-step process. So the question is, how much do I need? How much do I need in the bank in order to take home $5,000 a month forever? Now, I'm just choosing $5,000, but you need to think through, your home will be paid for, you won't have children anymore, you might want to travel. Maybe $5,000 a month is good, maybe $8,000 a month. It depends on, maybe $3,000 a month. It depends on where you are. And I'm using 5%. That's a pretty conservative amount of return. The stock market gets about 15%, but it's quite risky. So you need to not consider that as a source of income. You probably would look at something like a good savings account, which is 5% a year. And that's what I've included here. One of the interesting things that when we have an infinite life, if you think about this, the interest that you can take off of a bank account every year without going into the principal is equal to the principal amount times the interest rate. So let's say I have $100 in the bank and it earns 5%. I can take $5 out of my bank account every year, 5% times 100, and I'll never go into the $100. I can just take that 5% off every year going forward. And so if I write this, it's A is equal to, or A, the annual amount I can take out is equal to the principal, the present value, times the interest rate. And that's for n is equal to infinity. And the infinity signs aren't coming up at the right time, but that's what it is. So if I rearrange this and I'm wanting to find out what's the principal amount such that I can take out a certain amount every year forever, what is that principal amount? So I'm including a period as 1 month because I want to have $5,000 per month. So my interest per month is 5% divided by 12, or 0.417%. And if I want $5,000, I use that equation P is equal to A divided by I, and I get the principal then that I need is 1.2 million in order to get $5,000 a month forever. That's really super important, this idea of when the time is infinite, you can use this equation. So now I know how much I need. I need 1.2 million. So this is the equation I used in Excel, just so you know you can do that calculation. So now I know that I need 1.2 million, so now I can look at the second part of the particular equation, or the first part, to say, well, if I need 1.2 million, how much do I need to put in the bank for the next 40 years? And then I can do a calculation on that. So I want to know how much I need to deposit in order to get 1.2 million in the bank after 40 years if I'm earning 5%. So I'm defining a period as 1 month. The future value now is 1.2 million, and my rate is 5% divided by 12. Number of periods is 40 years times 12, because remember we're doing months, so we need that to be 480 months. And then the payment equation, if you remember, it has rate, number of periods, present value, and then future value. You can see there I have 2 commas because I don't have a present value, I only have a future value. So I want to know how much am I going to be, what is my payment going to be in order to get 1.2 million into the future? And I've done that equation is in Excel here. So that means I need to deposit $786 in the bank every month. So if it's matching, then I would be depositing half of that. So $380 every month, 390. So I would be depositing that every month, and then the company matches it, and then I will have $1.2 million when I retire that will then support a $5,000 a month withdrawal. So we've just figured this out. We need $786 per month to be put in the bank. That's a lot, especially if the company's not matching. That's a lot. But you need to remember that, as I can't emphasize enough that this is a real life example. When you start working, make sure you're putting between $500 and $1,000 a month into your retirement in order to get enough money when you retire. So we can look at sort of another example using this retirement issue. So what I'm doing here is I can say, what's the future value if I put a certain amount in the bank into the future? So I'm going to look at this example. How much will I have to deposit? How much will I have if I deposit $100 a month for 50 years in a savings account that earns 6% annual interest? So this is a little bit less contributions and a little bit higher interest rate. Again, I'm defining the period as a month. So my rate is 6 divided by 12, or 0.5%. The number of periods is 600 months. I have a $100 payment. So in this case, I'm using this equation, the future value, and I put that in, and I get a number of 378,000. So if I put $100 in the bank for 50 years, $100 a month for 50 years, I'll get 378,000. That's not going to be quite enough for you to live off, but it will be some amount. And that's going to be what I can take out of the bank in 50 years. So we're going to look at just another way of looking at this, a little bit related to a payment. So how much will I need to deposit each month for 50 years in a savings account that earns 6% annual interest if I want $3 million at age 50. So my period of definition is 1 month, 0.5% a month for 600 months. I have a present value of 0 because I'm actually, if you look at the arguments that are necessary for that function, we need a present value, so I need to put that at 0. And the future value is 3 million. So I type in this particular equation, and I get that I'm going to need to deposit $792 every month to get $3 million at the end. So I hope that gives you an idea of how to put together these this calculation. One thing I want you to take away from this particular video is it's super important to me that the moment you start working, that you are depositing $500 to $1,000 per month into retirement in order to have enough money at the end of when you retire to live how you'd like to live. It's super important that you remember this. So this particular video is about personal financial decisions.